Hello everyone, Simon Says Money here. Welcome back to another video. I hope you guys are enjoying a great weekend and are getting ready for a great trading week. Today I'll be discussing the topic of SPAC ETFs. SPACs have been pretty hot lately, and if you don't want to take the risk of an individual company that is a SPAC, then there's ETFs, and I'll get more into that. Before we get into this video, don't forget to like and subscribe and turn on that bell notification for more stock market videos like these. And as a disclaimer, I'm not a financial advisor or a CPA. Please use your own investment decision, and this is for education and entertainment purposes only. Now, without further ado, let's go ahead and get into today's video. If you are a new stock trader, then very likely what you do at the beginning is like this, and it happens multiple times. You're a new trader, you want to get into individual stocks, and boom, you get slapped in the face and you start losing a lot of money. We want to become experienced traders like this, but it takes time and it takes hard lessons, which means lots of loss of money. Therefore, maybe at the beginning, it would be a good idea to invest in an ETF, which usually presents less risk and reward is still significant. We'll still want to maximize our return on our investment. People have heard a lot about SPACs recently because of their high returns. In 2020, the hottest investment was, strangely, the Special Purpose Acquisition Company, also known as SPAC. These once obscure investment vehicles made hedge fund legend Bill Ackman $1.4 billion in less than a year, and now are backed by high-profile athletes such as Shaquille O'Neal, Alex Rodriguez, Serena Williams, as well as other celebrities like Grammy Award-winning singer Kiara and astronaut Scott Kelly, as well as music mogul David Geffen. Chamath Palihapitiya also has a series of SPAC, IPO-A, IPO-B, IPO-C, IPO-D, etc. Chamath is also known as SPAC. The star is also dazzling, but SPAC ETFs can differ greatly, making difficult to understand and volatile product even trickier to invest in. In a CNBC article published Saturday, February 13th, SPACs used to be a joke in Silicon Valley. Now they're going mainstream. Venture capitalist points to SPAC announcement by SoFi, 23andMe, Desktop Metal, and Matterport as a clear sign that higher quality companies are choosing that route to the public market. The surging number of SPACs on the market, coupled with participation by top institutional investors, have made the process cost-efficient and credible. SPACs are stealing from the 2021 IPO calendar, said Peter Herbert, co-founder of venture firm Lux Capital. SPACs are shell companies that raise cash from investors through an initial public offering. The money is then used to acquire an existing, typically a privately held company, in order to bring it public with less hassle and less scrutiny. It means that they take companies public without going through the traditional IPO process. Through SPACs has been around for decades, 2020 saw a strong resurgence. Many investors like the trend toward popular themes such as electric vehicles and green energy. Through their real appeal has been the larger deal sizes and the high-profile sponsors. About 250 SPACs raised $83 billion in 2020, 6 times more than in 2019. Just 6 weeks into 2021, the numbers have already reached about half of the 2020 numbers. So why do SPACs attract so many investors? SPACs can be attractive in that they allow retail investors to participate and to invest in private equity type transactions in an IPO before the actual listing, something usually only available to venture capital or private equity firms, and potentially capture the big gains if the newly public firms turns out to be successful. But SPACs are risky because early investors don't know what the merger target will be, nor is the deal guaranteed at all. That's why SPACs are also called blank check companies. SPACs are not backed by any real business operations, yet investors anticipate for the next big hit can sometimes drive the price up even higher, but even before the deal is announced. Essentially, investors are paying for the reputation of the deal sponsor, and that can be pricey. If the merged company doesn't live up to its expectation, share prices could plunge. In my previous videos, I have presented a few SPACs already, like CCIV, Churchill Capital, which just announced merger with Lucid, and its stock price soared by more than 26%. CCIV is actually at $52.94. It was down 8.8% on Friday, and then after market, it was up 2.76%. So crazy amounts of gain. In just 1 month, we are seeing a 197% return from Churchill Capital. Also, Skills, the gaming company, was also listed through the SPAC approach, and its stock price share has gone up more than 30% since I posted my video. Another one, SPCE, Virgin Galactic Holdings. I presented this SPAC in my ARCX video. Its share price has simply doubled since my posting of the video. Right now, Virgin Galactic price is at $41.19. But not every SPAC has such a great success. And most importantly, patience is much needed for a SPAC to announce its merger and its merger a success. A diversified exchange-traded fund, or ETF, can mitigate some of the risk and smoothen the ride. Most, however, are very new, quite small, and considerably more expensive than the typical ETF. Today, I am going to present 3 SPAC ETFs. So this is a rundown of the table. The first one is SPAK, and then SPCX, and SPXZ. Okay, let's go into each one of them into the details and analyze their pros and cons. Defiance Next Gen SPAC Derived, SPAK. It's the only passive index tracking fund devoted to SPACs. It currently has 136 holdings weighted by market value. All its holdings must meet minimum liquidity and size requirements. The fund charges 0.45% annually, which is pretty standard like any other ETF. The ETF SPAK allocates just 40% of assets to the newly listed pre-merger SPACs. The remaining 60% goes to the companies that became public after merging with a SPAC. This can help offset some of the volatility in the SPAC market and offer investors diversified exposure to the post-merger stock. According to the study by Edge Consulting Group, of the 115 completed SPAC mergers from 2016 to 2020, 65% of their stocks had declined a month after the merger closed, 71% were down a year later. The ETF SPAK plans to hold post-merger stock up to 2 years after they go public. My second SPAC ETF is an actively managed ETF, SPAC and New Issue SPCX. Launched by the Tuttle Tactical Management, the fund usually sells a SPAC after a merger is announced. Therefore, if you buy a SPAC, you need to closely pay attention to this ETF, because if this ETF buys in a SPAC, it means the news or rumors is about to leak out. Once the announcement is made about an official merger, this ETF's SPCX will sell its holding, very probably leading to the SPAC share price to drop. It charges 0.95% annually, which is in the high side of ETF's annual fees, but in the average for an active ETF. One of the big value adds of an active fund is that it can subscribe to a SPAC's IPO, while index fund and retail investors have to purchase those shares later, which usually are higher in the secondary market. Since SPAC shares can be redeemed for $10, the investment is essentially guaranteed not to lose money. The third ETF I am presenting is Morgan Creek Exos SPAC originated ETF, ticker symbol SPXZ. It is a mix of the above 2 ETFs. The annual fee is 1%. The fund is actively managed, and the fund is 33% invested in pre-merger SPAC and 66% in post-merger stocks. We can also see these SPAC ETFs. This one's SPAK ETF. There's a website, defianceetf.com/SPAK, and look at the current holdings. You see there's DraftKings, Virgin Galactic, and etc. Also the SPCX, you can see the holdings they have right here. One notable mention is the Gores holding, probably for the Matterport, and that should be a huge one. Matterport and CCIV are probably 2 of the most popular SPAC right now. And also SPXS ETF guide, all the expense ratio, financial that you can find on their site. Alright, that's it for today's video. If you believe that investing in the individual SPAC is too risky and you don't have a lot of patience, investing in SPAC ETFs might be an excellent idea because of its relatively low risk and potential high returns as compared to regular ETF. Don't forget to hit that like and subscribe button with notification, and comment below if you're holding any SPAC or what kind of videos you would like me to post in the future. I really appreciate your feedback and your support. Again, thanks so much for watching, and I'll see you guys in the next video.